Today, we're going to be diving into the difference between the two main types of life insurance, term versus permanent, and the different types of policies that you will find in each category. This video is really meant for brand new agents that are currently studying for their test or new agents that are on the field. However, if you're just here because you want to learn for yourself, we welcome you to continue to watch. My name is Amanda Ryba. I have been a licensed financial coach and consultant for the past 8 years as of the date this video was produced. And it is my goal to illuminate to the world what wealthy people know and understand about money. And one thing all wealthy people understand is the power of leveraging the tax-free benefits of life insurance to protect their estate. Now, if you are new to the insurance industry, this is something you need to understand. You need to know the different types of policies we put into place and why and how they're beneficial to the client. So let's dive in. First, let's take a look at term insurance. Term, think temporary. It's only good for a certain amount of years. 10, 15, 20, 25, or 30 years typically is the maximum amount of years you can get access to that policy. What that means is if you were to die during the amount of time that that policy is active, that policy will pay out the death benefit to your beneficiaries, all tax-free. If you were to pass away after that policy expires, your family doesn't get anything. The policy is done if you did not renew it. So the best way to explain term insurance is think of it kind of like you're renting or leasing the car. When you're putting money into that, you have the insurance, but as soon as you stop putting money into it, the insurance is done. Now, I will say it's a lot less expensive. So term insurance is really great for anybody that needs access to a lot of life insurance for a very small amount per month. So maybe somebody can't afford the money that it would take to take on a permanent policy, or maybe they're just looking for a certain amount of coverage because they have a lot of liabilities, they have debt, or they have a family to support. This is great for really anybody in their late 20s, 30s, 40s, 50s, even into their 60s that have debt that they're trying to pay down, that have a mortgage they need to pay off, that have families they need to support, and people dependent on their income. Because again, you can get a lot of life insurance for a very small amount per month. And nowadays, term insurance also comes with something called living benefits. Now, not every insurance carrier offers this, but most of the ones that I work with do. Living benefits means if this person were to get critically, chronically, or terminally sick or injured, they have access to the death benefit of that insurance policy while they are alive to pay for basically anything that they need while they're recovering. Now, every insurance company is different around how they give you access to this benefit, but it's a huge feature. The statistic is today that only 2% of traditional term insurance policies actually pay out, meaning that person dies while they have that term insurance policy in place, where up to 70% of people access the living benefit feature of their life insurance policy. So would you rather have the type of insurance where you only would access it maybe 2% of the time or possibly 70% of the time? That's where term insurance with living benefits comes in. Then there's permanent life insurance. And permanent life insurance is designed to last you for as long as you live. Permanent, think permanent. You will have it forever as long as there's money inside that policy to cover the cost of the insurance. Now, it's important to know that there's two main components to all permanent life insurance policies. There is your cash value component and there is your life insurance component. The cash value is what you have accessible to you in the form of policy loans in the future for anything that you need. That's the cash, the savings account growing behind your life insurance policy. Then there is also the death benefit. This is what would pay out to your beneficiaries when you pass away, tax-free. Now, there are some insurance policies that are permanent life insurance that combine these two together and pay out both to your beneficiaries when you pass away, all tax-free. And there are other kinds of permanent life insurance policies that do not combine these two together. They keep them separate. And you only have access to the cash value while you're alive. Your family has access to that death benefit when you pass away. We're going to talk about both of them coming up because there are two main distinct types of permanent life insurance with subcategories. Let's dive in. Let's start with the oldest kind of permanent life insurance today, which is whole life insurance. Whole life insurance has literally been around for hundreds of years. The oldest kind of permanent life insurance that exists today. And I kind of tell people, think of it kind of like the iPhone 1, right? Everybody's heard of it. It may not be the most popular to use anymore today, but it does still exist. So whole life insurance gives you a flat cost for the cost of the life insurance throughout the course of your entire life. That cost is not going to go up or down. It's going to stay constant. It does grow a cash value component to it. And that cash value component is a combination of your fixed rate plus your dividend rate. That's going to equal usually somewhere between maybe 5 to 6% interest earned on average every single year. Now, it's important to remember that dividends are not guaranteed. And just to give you a little idea, dividends are basically when the insurance company that your policy is held through does well, has a good year, right? They pay profits back to the policyholders in the form of dividends. Now, again, they're not guaranteed, but if you work with a really reputable grade A mutual insurance company, it's very unlikely that you would never not receive your dividends, but they are legally not allowed to say that it's guaranteed. That was the first kind of permanent life insurance. The second kind of permanent life insurance is universal life insurance. Universal means flexible. Think flexible premium, flexible death benefit. You have the ability to make some changes to this policy throughout the course of your life, unlike you will be able to do with whole life insurance. So universal life insurance means you can make changes to it. It also means you have the ability to do either an increasing or a level death benefit. So if you remember from earlier, where you have that cash value component and that death benefit component. With universal life insurance, you have the ability to combine them for your beneficiaries when you pass away so they collect both tax-free, or you have the ability to keep them separate in what we call a level death benefit, which means you only have access to the cash and your family only has access to the death benefit when you die. The first one we'll take a look at is universal life insurance, just simple universal life insurance. It's designed to give you more of a guaranteed rate of return, such as an average about 5% is typically what you see. Of course, we get the permanent life insurance and the ability to choose an increasing or a level death benefit. The second kind of universal life insurance is called variable universal life insurance. This is when the insurance companies decided to give you the option to put your cash value into the stock market, which means you're going to see it go up and down. But now, because the insurance company is no longer taking on the investment risk of your insurance policy, they cannot keep your cash value inside the insurance company's general account like they do with the other types of permanent life insurance. They have to separate it. They have to put in what's called a separate account. So if you see that when you're studying for your test, if you ever see them talk about separate and general accounts, that's already your key that they're talking about variable universal life. And if they talk about sub accounts, which you're going to see here, that is the underlying investment that they're putting your cash value into, because your cash value will grow in the stock market in a mix of stocks, bonds, mutual funds, things like that. You do need to have a securities license in order to help clients with a variable universal life insurance policy. So if you ever see the term securities, FINRA, SEC, anything like that, again, those are all key indicators that they're talking to you about variable universal life insurance. Obviously still grows a cash value, obviously still has a death benefit. The downside is there's no guarantee to this. And there does also tend to be some higher fees when it comes to variable universal life because, again, your money is in an investment. So it tends to be a little bit more of an expensive product for the client to own. But again, it could be great. It just depends on the client's overall goal for their money. And the third kind of permanent life insurance is index universal life insurance. Index universal life insurance is kind of like the iPhone 15, where whole life was the iPhone 1. Universal life, I'd say, is like your iPhone 6, maybe 7. Variable universal life is kind of like your 10, 11, 12, somewhere around there. Index universal life, or what we call IULs, are kind of like your iPhone 14, 15. Latest and greatest on the market. They came into the space around 1998, and that was when the insurance companies allowed clients to start to leverage an index strategy, which has been around since 1913, inside of their life insurance policies, which is super cool. It allows you as the client to track a stock market index of your choosing, not be invested inside of it like it is with a variable universal life policy. You're just mirroring it. You're tracking its growth, meaning you get to grow when the market does well, but when the market tanks, you're locking in that cash value so you don't lose anything. Much less expensive than variable universal life policies because it's not an investment. You don't need a securities license to offer this to clients like you do again with a VUL. This is just a product that allows the client to get the feel of investing, but without the risk and without the cost of it. Now, it's definitely not too good to be true. I always tell clients it's just too good to be free. There's always a way the insurance company will profit. So they could take maybe what we call like a spread, which is just a percentage off the top of what you make tracking that index. They could put in a cap, it means that you can't earn over a certain percent, or they could simply just charge you a fee, maybe 1% per year or so to be in that index, but that guarantees that you will not lose when the market goes negative. Now, there's a bunch of different index options the clients can choose to track. Could be your basic S&P 500, maybe the European markets, the Hang Seng markets, the NASDAQ, the Dow Jones, or some customized indexes that the insurance company offers. And there are some that are non-capped, that are completely uncapped, that can grow as whatever the market does. So it just, again, depends on the client's goal. But the key features that you need to understand here is there is growth with no risk and less cost than your variable universal life policies, right? So IULs have the chance to earn higher interest. They do also have fixed strategies that clients can choose, similar to what you'd see in a whole life or a universal life. But the key is just chance to earn higher interest. Whew, that was a lot, right? Well, I know when you're studying, all these terms can be really confusing. Sometimes it just helps to see pictures, to see little graphs and charts and numbers to help us distinguish the differences between these types of life insurance. Again, permanent life insurance is really best for anybody that wants life insurance for as long as they live. They don't ever want to worry about that expiring, where term insurance is really great for people that need access to a lot of life insurance for a very small amount per month. Either their budget isn't big enough for a permanent life insurance policy, or again, they just need a lot of insurance because they're heavily leveraged. That's where your term insurance is going to come in. Most of the clients that I sit down with end up getting a combination of the two, where they might get a smaller permanent life insurance policy with the intent for that to grow cash value for them, and then a larger term insurance policy to get them access to a bigger death benefit if they're at a point in their life where they are heavily leveraged and people are dependent on their income. So again, hopefully this was helpful. This video is definitely designed more so for agents that are studying or new to the industry. If you got the chance to watch this and you're neither of those, you're just a client looking for more information for yourself, I love it. Thank you for staying till the end. Give me a high five below and let me know what you learned. Feel free to share this video, you guys, with anyone else that you can think of that's a new agent that's studying or that would also just benefit from this knowledge. If you have any questions, and let's say you're an agent but you're looking to get connected to a good team that can train you, or you're a client looking for more information on these types of policies for yourself, let's connect. I'm based out of the United States. I'm licensed pretty much everywhere. So all you have to do is just click the link in my bio. That's going to take you directly over to my calendar where you can schedule a complimentary consultation with me or my team. I would love to meet you. And if you like this video and want to see more videos just like it, click that subscribe button and hit the bell to turn on notifications because I release a new video every single week and you won't want to miss it. So again, this is Amanda Ryba, illuminating to the world what wealthy people know and understand about money. And if you're going to work in the insurance space, you need to understand the different types of insurance policies that are available for you to help clients out with. So again, please share this video, drop a comment below because it helps others see this and things that you liked and learned. And I will see you back here next week on YouTube.